MasterCraft, which is actually a name that has come up in a lot of value investing circles, is down over 33% this year. And so the question is now the time to purchase a security? Is this an opportunity? That's what we're going to dive into in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now MasterCraft, you can see their share price is down 34% in the last 6 months, and it's effectively trading at a PE ratio of 4 times earnings. Now remember, that's a trailing PE ratio. That's not necessarily what the future earnings of the company will be. And of course, part of the reason why the shares are down is because the expected earnings in the future are not going to be the same. The E is not going to be the same as what it was previously. And before we get into the guidance, I just wanted to show you what these guys are all about. So, the main brand is the ski wake boats. This is apparently the fastest growing, highest margin category of the powerboating industry. They also have pontoon boats and they have luxury day boats. I would probably say that I'm more in this area and not necessarily this one. Actually, this kind of looks cool too. But what actually happened? Why did the stocks trade lower? Well, it's because the boat maker provided tough guidance. So they said that they're warning the investment community of a rapid slowdown in boat sales amid higher interest rates and mounting dealer inventory. And so they're saying that macroeconomic factors, including elevated interest rates as well as tightening credit standards and availability, are creating a significant uncertainty. And so the question is, what business isn't facing that level of uncertainty? And so what I really want to look for in this type of situation is, can the business survive the downturn? And does the business have a product that is sustainable over the future? I really do believe that MasterCraft has a product that is sustainable over the future. The name is just synonymous in that particular boating segment. So the question is, does the company have the ability to sustain or weather this type of slowdown? And I really think they do, and I will show you in this video. And so here's the guidance that they provided. You can tell that they expect net sales of between $390 and $420 million next year in fiscal 2024. That is an approximate 40% decline year over year. And this wasn't unexpected. I definitely expected a slowdown. I had already been forecasting a slowdown, so this is just fine with me. Their adjusted earnings per share is obviously going to come down because lower revenue hurts profitability, which is why expected EPS is lower than just a linear pattern decline. And so you'll see a huge decline year over year based on this forecast, but it's $1.50 to approximately $2 per share. And so why is this happening? Well, they're telling you right now, dealer inventories ended the year at levels higher than they would have considered optimal. The macroeconomic environment is unsupportive, and the 2024 production plans have to be rebalanced to adjust to the higher dealer inventory based on the projected demand. So they're just going to sell fewer boats in through the channels. But the question I have is, can the company sustain itself? Well, look, first of all, the company is still going to be profitable, right? They're making an earnings per share here. So that's really good news in a tougher environment. And the second thing is, the company has a fortress balance sheet, which I will show you. And so they have a record amount of cash on their balance sheet, and the cash can just be used to pay off all of that debt. Obviously, they don't have to pay it all off, so they can use that debt to be flexible. But this is one of those situations where, hey, you can weather the storm. And so if the share price is low enough where it creates a wonderful type of opportunity, this might actually be one of those positions that I enter into, taking into account like a 5-year time horizon where I expect the company's share prices to rebound. And, it may not necessarily be operate in that exact scenario, but let's take a look at the numbers and see what happens. And so once again, here is their guidance. So they're expecting between $390 and $420 million of revenue next year. So that's really positive. Obviously, it's $1.50 to $2 per share of EPS. So that's great. But here's the thing. They expect to generate positive free cash flow despite the significant decline in earnings from 2023. So not only do they have a fortress balance sheet, but they also expect to generate positive free cash flow in the next year. So that tells me that this company, although it's not making super amounts of income, they're not making the same high levels of income that they were in the previous couple of years, they're still profitable. So that tells me from a going concern perspective, this company is going to be around. And when the market turns, their revenues and earnings will more likely than not revert back to their historical levels. And does that mean that the stock reverts back? I think so. Now here's the model that I have that all the Patreons get get access to. And so notice that in 2023, they actually made approximately $4 per share. So you could tell that that $1.50 to approximately $2 per share is much lower guidance than what they earned in 2023. And, I just want to point out that it is hard to gauge this business pre-2019, even like pre-2020. And so like the real area where you'd probably look to forecast the results for 2021 and beyond. But of course, these are elevated years. And so I wouldn't even use these. I'd probably say that this is maybe a $2.50 run rate type of business. And the reason for which is because they made 2 acquisitions and they sold a business in between 2018 and 2022. And this is what I'm talking about. In 2018, they actually acquired Crest. So when I showed you that image of what they make, they had 3 boat brands that they were showing. They were showing Mastercraft, Crest, and Aviara. And so the second one that I showed you earlier, the pontoon boats, they actually acquired the pontoon boat company for $81 million in 2018. The other acquisition that they made was in 2017. Both acquisitions were in October for some reason. And so I guess they get into the acquiring mood right before Halloween. And to be honest, this one was a scary one because they acquired Nautic Star for $80 million in 2017. And they sold it in September of 2022, and they took a $22.5 million loss on the sale. So it just makes it very confusing with respect to how you want to forecast out the business. And so I just took a sort of like a higher level approach. Just putting a finger in the air, what is the average run rate for this business, or at least what could it be? They're forecasting around $2 per share in a tough environment. So I'd say in an average environment, it's probably $2.50 a share at the base level. So what does that mean in terms of what price I'd want to pay for this security? Well, just doing a quick and dirty, you can see that, if it's around a $2.50 per share business and I want at least a 15% equity yield on it, the share price that I would pay is around $16, maybe $17 per share. However, I'm greedy. And it's a variable business. I would say that I would really feel comfortable at around $15 per share or even lower. And, the valuation will tell us exactly what that 50% of intrinsic value would be, but I'm thinking something under $15 per share. You guys recall from the first slide that it's trading at around $21.33 per share. So it's not really there. And I could look at the options to see if I can bring my net purchase price down a little bit, but ideally, I'd like to get it a little bit lower. And just jumping into the forecast part of the model that, of course, you can get access to at that lower tier of the Patreon, you can see that I've booked in revenue coming down by 40% in 2024. And then in 2025, I actually booked revenue coming down another 5%. I'm just assuming that the uncertainty remains. And then, of course, no growth in 2026 and then just 5% growth thereafter. I've taken their margins back up in the subsequent years because, I've taken it to historical low levels in 2024. And of course, I brought SG&A up a bit because I think, the company has a lot of operating leverage, but when revenue goes down, of course, a big chunk of the SG&A will probably remain or just become a higher percentage of the overall revenue. So I just brought this up, but this might be where I might have too much cost. So just FYI, the SG&A might be forecasted heavy, but I'd rather forecast it heavy and be a little bit more conservative when it comes to what price point I want to pick up the security at. Now, once again, you can get access to that model and all of the other models that the Patreons get access to at this lower tier. And like I always say, there's a 100% money back guarantee if you do not feel as though it is worth your money in the first month. And so because there's nothing for you to lose, I really encourage you to try it out. Now, let's take a look at that fortress balance sheet that they were talking about. Okay, so here's their balance sheet. So you can see the cash right now is sitting at approximately $111 million. And their debt, their long-term debt is $50 million and their short-term debt is $4 million. So you can see that they have absolutely a fortress balance sheet right now. And they probably have off-balance sheet financing available as well. They probably have lines of credits and et cetera that they can draw on if they need to. But the whole point here is that this company can absolutely weather the storm even if they didn't have positive free cash flow in 2024, but of course they do expect positive free cash flow, so they can weather this storm, which is really good in terms of the going concern. And so all that leaves for us is what exactly is the valuation, or at least what I think the valuation is. So I believe that the company's worth around $36 per share, $37 per share. It's currently trading at $21 per share, which reflects around 60% of its intrinsic value. And like I said, because it's $36 per share, you know, $18, $17, $16, $15, that's probably where I'd want to get it. If the run rate for earnings is around $2.50 per share, then of course I'd want to take it at anything under $17 per share. So this is one of those names where I'm happy to let it come to me, but of course you can see that it's trading at approximately 13 times the earnings that are expected in the next fiscal year, which reflects an 8% equity yield. So not bad, not a bad valuation at all. You can absolutely throw it into your portfolio right now. I'm just going to wait a little bit, let this opportunity come to me. And you know, if it starts trading under $17 per share, I'll absolutely pick it up. I want to know what you guys think. Let me know in the comments below. I respond to absolutely everyone. Now, I also released a video earlier today where I spoke about how you can find stocks that will 10x. And if you missed that video, you can get access to it right here.